Hey, good morning. Welcome, everybody. Today is Thursday morning, February 27, 2020. Welcome to today's episode of Stocks for Breakfast. My name is Pete Marzulli, and the coronavirus is continuing to dominate the headlines. Today, it is about Microsoft making an announcement about how it's affecting supply chains. But today, I think the main thing we're going to discuss is two things: managing risk in this incredibly bearish, volatile environment, and we're also going to discuss whether or not day trading or swing trading is safer, in my opinion. And safer is relative. I'm going to build an argument for both sides, and you can decide which one is correct for you. If you find these videos helpful, please scroll down, click subscribe. I'd love to have you get updates so that you can know when new videos come out. So with that, we're going to go straight to the charts and see what's going on. So we're going to start out with the futures again. Even though it's stocks for breakfast, it's very important to know your pre-market levels, especially in this environment. So you can see here on the chart we have, this is the level where yesterday afternoon we spotted 2 days in a row massive buying and massive volume coming in between 313 and 316 in the SPY. Here in the futures, you can see that it actually traded a little bit lower. And today's futures are actually trading lower because of the Microsoft outbreak. So you can see the futures tumble on U.S. first coronavirus case. Microsoft is worried about coronavirus disrupting their supply chain. Excuse me, it's a little early. So you can see that there's a lot going on here with Microsoft, and it's obviously affecting the rest of the market. Microsoft traded into an inside day yesterday, and almost an inside day, which holding the bid after a big move like that actually shows that there's more buying into the market, but now it's just the pressure is just too much, and we're actually trading lower again. So you can see here Microsoft is actually down $3. We do have a couple of earnings today. Bed Bath & Beyond is actually one of them, as well as Baidu. So those are a couple of things that you can keep an eye on. So again, I'm not changing my number as far as where I believe massive buying came in and supported the stock. Fresh news came in overnight, which is obviously going to dictate a change in what's going on in the overall bigger picture. Now, again, if you're new to the channel, if you're new to the videos, or if you happen to missed it last time, my world is tape reading the charts, and hopefully I can continue to show you how I do that so you can feel confident, 100% conviction. But the charts are always superseded by serious news, and we have serious news. Now, again, sometimes it could be earnings, sometimes it could be anything along those lines. Obviously, the most predictable serious news is earnings from quarter to quarter, and we trade those stocks in that direction from quarter to quarter using the charts. However, this is a big deal. And the reason I say this is a big deal is that the amount of the world that it's affecting is astronomical. There's really no other way to say it. And the reason I keep bringing this up is because I'm getting tremendous feedback. People are sending me emails, and if you want, the email will be below this video about how to trade this market. And the majority of the questions that are coming in, they're specific to chart points. Chart points don't matter when the news is this serious. There's really no other way to put it. You're not going to have a stock stop at support when something as big as the coronavirus is hitting. Now, we're going to discuss longer term investments versus swing trading versus day trading. Your longer term investments, I heard Jim Cramer yesterday talk about we're only down 3% or whatever the percentage it is from the top in the overall market, especially in the Dow. We have to keep in context how strong the market has been for the last few years. And I think that we've been so blinded by the fact that it hasn't had any kind of a significant pullback. A lot of people are overreacting to the pullback. Yes, obviously it's a pullback. Yes, obviously your 401k has pulled back. But in the grand context of things, this is a normal market. What we had prior to this was not a normal market where the market, and I'm going to exaggerate a little bit here, but where the market hardly pulled back to offer any realistic opportunities to buy or add to positions on profit taking. We just kind of kept melting higher, which, by the way, there's two different kinds of markets. One is where you're grinding higher, and there's one where you get a nice ebb and flow in the market where you're making peaks and coming back, making peaks and coming back. If it's a grinding market, moving averages generally work better. If it's a peak moving back and forth market, usually stochastics or MACD, or if you're part of our coaching program, you know that we're looking for swing highs, swing lows, and that kind of thing. So the kind of market that you're in is going to dictate what your trading strategy is going to be, or what tactics you're going to use to implement on the market. So that being said, I want to touch very briefly on day trading versus swing trading specifically. And I'm going to actually leave the screen, and then I'm going to go back to the screen there. Day trading versus swing trading. Now, a lot of people who have never professionally traded before have not had the experience of being in front of a screen all day, trying to make your living as a day trader, a full-time trader. Now, I also want to make the distinction between day trading for a living versus trading for a living. Not the same thing, because you could trade for a living, buy a stock on Monday and get out of it the following Monday, and you're still trading for a living if that's how you make your income. Day traders, real day traders, which is my universe, I've been doing it since 2000. Generally speaking, there's a misnomer about how most professional day traders make their living. If you're new to the market, you're generally trading and opening opening new positions after the market opens and closing those positions out before the market closes. And the language that you use is you went home flat for the day. Generally speaking, if you're trading for a prop firm like I owned in New York City, if you're inexperienced, you make your new traders close all their positions out at the end of the day, and they come in flat the next day, and they just look for new trades. Now, on the surface, that could be considered lower risk because you don't have overnight exposure. If a trader has discipline, you don't have overnight exposure, and you're managing your stop losses within a pretty tight window. So you have a 5-minute chart, or some traders go all the way down to the 1-minute chart. I don't do that anymore. The shortest one I go to is a 5-minute chart. And you feel like that spot where you're managing risk keeps your risk lower in exchange for the next position. So some might consider that safer. And I'm going to use safer, and if you can't see, I'm using safer in quotation marks because I'm not saying they're safe trades. I'm saying you could manage risk differently because it's tighter, assuming you have discipline. The downside to that is you don't have larger moves. So you're really kind of grinding it out during the day. Very, very common for a day trader to be trading anywhere from 25 to 50 to 75 trades sometimes during the day. You're putting up positions, taking them off, putting them on, taking them off. And it's very common for a day trader to say, I'm trading around a position. Now I'm going to jump over to swing trading. Swing trading in the purest sense from a professional trader's point of view. And I'm going to say, from my world, where you went from day trading, you proved you could make money where you're opening and closing the same day. The biggest traders that I've traded with have used day trading strategies to what I call get a head start on a position. And then if that position closed strongly in their favor, they would carry it for the next couple of days. So you're using the shorter time frame day trading entry techniques to hold positions and build positions in a longer term order flow. Whether it's bullish or bearish doesn't make a difference. That's how most professional day traders that I've worked with have made millions, where they essentially use the micro time frames to, I'll just use the terminology that I use on my trading floors. We're always looking for a head start. You're looking for a spot where you can manage risk, get a head start, and then look to build that position if the order flow continues. The upside is you have massive upside potential if the stock continues to move and it becomes well bid a few days in a row or well offered a few days in a row. And you can hold those trades, and ultimately what we use is saturation points, where you get out at a certain point where you believe this price action has gone up enough where it's saturated, and that's kind of like the last gasp, and you expect it to turn around. The downside to that is kind of what we're experiencing now, is if you had some positions on and expected them to follow through, you experience the downside of the possibility of earning more as well. So I want to make it clear that, again, neither one of those strategies is right or wrong. Whether you should become a day trader or whether you should become a swing trader is completely independent on your own personal situation. I will say this, and this is based on a lot of experience. Like I said, I've been doing this since April of 2000. I've done it myself. I've driven a limo way back in the day to keep my trading career alive when I was first learning, and then eventually get to the point where you really know what you're doing and you can be consistent. I personally do not recommend anybody quitting their job to become a professional trader unless you have your personal expenses under control, meaning they're as low as possible, because being a trader is an entrepreneur, and you have months and months and months of profitable P&L. I've experienced it, seen the good side and the bad side, the tough side. I shouldn't say the bad side. The tough side that comes along with opening a business, because let's face it, trading is opening a business. Whether you feel that way or not, when you do it, it is opening a business. Your trading losses, your software, those are your business expenses in exchange for making revenue. But think about the upside to this. If you open a business and you prove you can build that business that has consistent revenue, then you can consider it. And even then, if you have a good job and you're making money on the side as a trader, in my opinion, in my experience, most people should probably do both, because of exactly what we're experiencing right now. It can be common if a trader gets caught off guard who doesn't have experience that, and maybe you've even experienced this now, where you can have money, you make money 5, 7, 10 days in a row or something like that, and one bad trade slips you up. It's the end of the month, and you give back 3/4 of what you made because you lost your discipline. Maybe you mistakenly averaged into a position believing it's going to come back, that kind of thing. And we've all done it. Anybody who tells you they haven't done it, they're full of beans. Everybody's done it. It doesn't work. I can tell you flat out now, I've done it in the past. You make money on 1 or 2 trades, that works out, and then all of a sudden, the one trade, it doesn't come out. It wipes out all the other ones. I don't recommend averaging into a position unless you're talking about much longer term investments where you're looking to buy stocks at a better price and you're going to hold them for years. But that's not what I'm talking about right now. Right now, I'm talking about day trading and swing trading. The market has more money than you. You will get slaughtered if you don't have discipline in the short time frame. So the point that I want to make here is there's upsides and there's downsides to day trading versus swing trading. Each has their own unique characteristics, and only you can decide should you be day trading or swing trading. I will say this: if you get to the point where you're massively consistent and you feel like you have a good grip on the shorter time frames as well as the longer time frames, meaning the intraday charts and the longer time frame charts, it does make sense to look to build positions using the day trading time frame to look to hold for swing trades. Because look, if you want 1,000 shares of a stock, you don't have to buy 1,000 shares immediately. It's just math. Let the stock prove itself first before you start to build that position, and then as it moves in your favor, you can learn to hold it and eventually look for that next move. So in my opinion, in my experience, I should say, I can't tell you what to do, but I can tell you what has worked for me, and that is using both of those scenarios. But I'm very famous for telling a story back in 2011 when I started trading a new strategy, which I just mentioned before, saturation plays. Even with all of my experience, for 3 months, I traded 100 shares of that new strategy, because you need to know, number one, does it work? And number two, can you follow it? And there is absolutely no reason, regardless of how much money you have in your trading account, to trade bigger until you define with real trades. And I'm going to touch on simulators in a second. When you touch it with real trades and your real skill level, you should never trade bigger until you prove it works and you prove you can follow it. And I want to say this to end the video. Actually, I'm going to touch on a couple of stocks before we end the video, but simulators do absolutely nothing in the real world. I don't care. I almost cursed there. I don't care how much money you've made in a simulator. You will never, ever take that into the real world and get the same results. There is zero emotion attached to placing money and fake trades in a simulator. Now, can you hone your skills and work on a strategy in a simulator? 100%. However, and should you? Yes. The question is, yes, you should. However, can you go and say, I'm going to replicate this because I made money in a simulator? The answer, I've never seen anybody do it. It's virtually 100% different. There's zero emotion. Now, of course, you're going to hold the stock when it pulls back. You're going to get perfect fills because that's where the last trade in print was. There's liquidity issues in the real market. There's how you're going to react. There's fills and all that kind of thing. Simulators are good, but don't mistake your simulating skill level. You're simulating prowess for what you're going to do in the real market. Can you make money in a simulator? Yes. Do I recommend you do it? Yes. Will that translate into exactly how you're going to do in the real world? No. However, here's what I do recommend. And again, this is based on experience. If you have a new strategy, and I'd love for you to learn mine, I'll have a link below the video. You can do that. It's called Order Flow and Saturation Plays with the New York method. If you have a new strategy, test it in the real world with real trades. Could be 50 shares, it could be 100 shares, but prove you can follow it. It's the single biggest thing that I see with coaching students when they come out of the program. They're full of discipline. They're full of the clean trades, the A+ trades, and they tend to make money immediately for the 10 days, 20 days, month after they finish the coaching program and finish the course. I shouldn't say the coaching program. Coaching program continues. But for some reason, the discipline goes out the window and they start taking trades where they'll get on a call with me and be like, I know it doesn't fit the strategy. I know it wasn't a part of the plan, but I took this trade. So I got news for you. Those are the reasons you don't get paid. It's those mediocre trades that have nothing to do with the probability of getting paid, nothing to do with your edge, nothing to do with your strategy. Those are the reasons you don't get paid. Anybody can make money when it's obvious. The trick is only placing trades when it's obvious and you have a really strong probability of making money on that trade. If you do your job right, prior to the trade is one of the most important parts of the trade because your risk is relative to the quality of your idea. And hopefully through these videos and Stocks for Breakfast, you're going to learn what that means, where something's obvious or it's not, and then how that translates into whether you should take the trade or not. And then ultimately we'll work together. You'll see some examples of how to manage those trades. So I just want to touch briefly. I'm going to go to the charts. If you're looking for some stocks that have gotten absolutely pounded, I'm going to go back to the daily charts here. If you're looking for some stocks that have gotten absolutely pounded, we are looking at the, what do you call it, cruise lines. Obviously, coronavirus is hitting these stocks hard. Now, if you're looking at some of these, they were actually recently making multi-year highs, and look where they are now. So I'm not really talking about day trading or swing trading here. I'm talking more along the lines of if you like the sector and you're looking for something to buy stocks at what many might consider a good price right now because of what's going on, this is the kind of situation where you say, if the fundamentals of the stock are still good, does it make sense to be buying this stock that is getting hit really hard on a real, I'm not going to say overreacting in a way that I trivialize it. Coronavirus is some serious stuff right now, probably the most serious thing going on in the world right now because it's affecting global markets. But I'm not so much talking about the seriousness of what's going on. I'm talking about, could you possibly be buying some of these stocks on the pullback or the collapse, I should say, if the fundamentals are good. Now, I'm not going to talk about fundamentals here. I'm a little bit more of a trader, but these are the type of situations where the same thing happened in 2007 during the financial crisis, where a lot of stocks that were 70, 80, 90, $100 and more came all the way down to 10. The situation unfolded where it was finally resolved without making light of the situation, and now many of those stocks are much, much higher. So you should be thinking to yourself right now, keeping an eye on these longer term positions that are getting hit very hard. Should I be building a position in a stock that I like the company and I believe in their long-term prospects, which is a lot different than what we're talking about day trading or swing trading. So some food for thought there, and that's obviously one of the biggest sectors that is getting hit right now, then possibly airlines as well. So my name is Pete Renzulli. I hope we gave you some really good insights today. I would actually watch this once or twice more because I really gave some good detail on day trading strategies versus swing trading strategies and how to implement both of them. So that's Stocks for Breakfast for Thursday, February 27th, 2020. And again, if you liked the video and you watched all the way to the end, I really appreciate it. Scroll down, leave a comment if you have any questions. Make sure you subscribe and give us a thumbs up if you felt like it helped you. Have a great day, everybody.